Good afternoon, everyone, and thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another one of our great webcasts featuring our Chief Executive Officer, David Burrows. On today's webcast, we will provide you with a brief macro overview, and of course, at the tail end of the conversation, be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, on this very warm July afternoon, I turn the conversation over to the one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thanks. So great to be back and looking forward to your webcast.
Awesome. Well, I want to welcome everybody on this Tuesday. Lots going on in the market, and certainly, lots to talk about. Interesting week. Michael Wilson, sort of at Morgan Stanley, threw in his towel on his bearish call, looking for another significant decline, believing that he may have been wrong on his call. Certainly, the market has been telling us otherwise. But let's just go from the top, because I think it's important when you go through periods like we've gone through from the beginning of 2022, people ask questions, people worry that maybe we're headed to some kind of calamitous decline like 2001 or 2007, 8, 9. Those things are still pretty close to the surface for a lot of people. And so we always have to ask the question, is that possible? Or does it look otherwise? Our view has been that, like the bull market in the 80s and 90s, where there were a series of bear markets and corrective periods, this would resolve higher, and that what comes after this type of correction is, very significant moves higher of 2 and 3 and 4 years. So we started into the correction in end of December 2021. 2022 was a difficult year. We hit a low in October at the rising 200-week moving average. Notice that in a structural bull market, you tend to be lower bound by that rising 200-week moving average, and that has been the case. We're now sitting about 4% for the S&P below the old highs. NASDAQ's about 7% from the old highs, so a little bit more. It went down more in 2022, but it certainly looks as though October was an important low. The S&P made its low on October the 6th. We've made a series of higher lows since then. The moving averages, which were at that point all pointed lower, slowly reversed. We now have the 200, 150-day, 50-day, 21-day, 9-day moving averages all tilted higher. And sadly, it's with a lot of people not on board. The flows all year long and through last year were into fixed income and out of stocks. The two areas that benefited the most were cash, T-bills, money market, and bonds. And that really hasn't resolved at this point. So sadly, as the market generally does, it bucks people off and scares them, and then turns around and runs away without them on board. And this is something that we've been working to make sure that we are not caught in this case. In fact, what this looks like is a very typical non-recessionary bear market. If we go back and look at all of the periods from 1928 to 2023, where we had non-recessionary bear markets, the average pullback to the worst point was 25.9% over about 210 days. If you look at the low on from January the 3rd, 2022 to the October low, it was 25.4%. Intraday, I think it was closer to 27, 282 days, right in the wheelhouse of a non-recessionary bear market. Now, the Dow Industrial Average, which had been lagging, which consolidated in a ever tightening range from October, worked its way higher, and eventually at the end of May started to play catch up. And the Dow Jones Industrial Average accelerated at the end of May, got up and out of this trading range, retested it from the top, and has been charging higher since. So the bullish percent of stocks in the Dow 30 that are in uptrends is over 80%. That's a very strong breadth. And a good improvement for this market. The TSX, which also has lagged, has put in a series of higher lows. All of the moving averages are headed now higher, although just starting. And this is something we want to see. We've talked a lot about the fact that global stocks, for the first time in many years, have outperformed US stocks over a 12-month period. When that happened, it tended to begin a long period of outperformance. So we talk a lot about the fact that there are these structural shifts that take place. And the most important thing as investors is to recognize that they have taken place and make sure you're positioned for them. I guarantee you that most people are not overweight equities. Most people are not weighted in global stocks, which have underperformed for over a decade. And this is where the hurt takes place. We know that the Japanese market, after 30 years of underperformance, has had a very sharp beginning to the year, taking us above the range, going all the way back to 1991. We know that India, after having a good year in 2020-21, headed into the Fed tightening cycle, moderated during that Fed tightening cycle, held at the long-term moving averages, and then has turned and ripped higher. We're 23% higher since June of last year. Emerging markets, which have underperformed since 2014, made their low in November, consolidated along the moving averages as things righted themselves, and we've seen a move higher here. Notably, China has lagged, but there are some really interesting parts of emerging markets which we've talked about over the last few weeks. We won't focus on them today. All of this to say that maybe the stampede into T-bills has come to an end. So you can see just how substantial this stampede into short-term money market was from the beginning of 2021. And not to say that it stopped, it has slowed. In the most recent period, just about $800 billion has gone into treasury bills, but certainly this has moderated. But there's a long way to go. Let's keep going. Leverage. So let's talk about positioning. Significant net leverage in the system in 2021, a significant deleveraging, yet really to pick up. What does it tell you? There is some leverage, but the leverage points to the fact that there's a lot of shorts in the market. And so, of course, those shorts are likely to have to cover. Let's look at the 10-year bond and rates in general. So just like we believe we're in a structural bull market for stocks that started in 2013, and that we've had an interruption, we had a significant move down in rates from 1981 to 2020, where likely we made a generational low. A lot like the generational low that happened at the end of the 1940s following the Second World War. Since then, we saw reacceleration in rates. And looking at it graphically, this is 1981. This is rates moving lower in fits and starts to the low in 2020, where we reversed. A lot of people believing that this was an opportunity to go buy bonds because we hadn't seen yields like this in some time. But we've now had over 12 months consolidating that move above the moving averages. Now moving averages moving higher. We have clearly reversed that long-term trend lower in yields. And just because yields have moved higher doesn't mean it's time for them to move lower. In fact, it's interesting, if you look at expectations for inflations, this is the 30-year break-even rate. It highlights the fact that there has been a significant shift in the trajectory of inflation, and one that is likely to be sticky. So the reason this is important is the things you own in an inflationary environment should be probably quite different than the things you own in a disinflationary environment. And while a lot of people felt that the Fed tightening cycle would bring on disinflation, we're going to talk today about the fact there's some very clear signs that that just isn't the case. But that being said, people are really overweight bonds, right? We're more overweight bonds at the end of May as an investing public than any time since the lows of the market in 2009. That's a move to a defensive positioning. But that hasn't worked very well. The aggregate bond index, which was down from the high in March of 2021, 22% into the lows last year, bounced, but that bounce is failing. All of the moving averages moving lower. We failed to make higher highs. In fact, now we're making lower lows. If you look at the TLT, which is the ETF that represents the 30-year bond, yields made a low in 2020 and bonds made a high in 2020, made a lower high in 2021, made a lower high in 2022, made a lower high in 2021, and again below all of the moving averages. So despite a stampede into fixed income and cash, this is not working out. Bonds are negative on the year. If we do a quick comparison, stocks, the S&P relative to the broad bond index, AGG, just note that we have resumed an outperformance of stocks versus bonds. And even through the bear market, there was no outperformance in bonds. A 50-50 portfolio of the S&P and the aggregate bond index last year was down 21%. Bonds were down 20%, stocks were down 20%. But in a rising rate environment, stocks tend to outperform, or in an inflationary or reflationary period, stocks are the way to maintain your purchasing power. So flow of funds into bonds and cash, flow of funds since 2021 out of equities. The crowd tends to do the wrong thing at the wrong time. And trust me, I understand. It always sounds smarter to be bearish. It always sounds smarter to be a skeptic. But the signaling from the market's giving us a very different picture. During the period of the bear market, dividend growth versus bonds gave an even return. But from the time when rates bottomed, dividend growth versus bonds way outperformed. From a thematic standpoint, we know in the 50s and 60s, dividend growers were the best part of the market during a period of rising interest rates. And here we are again, dividend growth reaccelerating as a theme. So for income investors, we believe the place to be is in a dividend growth strategy, not a fixed income strategy. Fixed income is what it sounds like. It's fixed income. And if rates go higher, that income looks less attractive. So if it was a generational low in 2020, it could be many, many years that dividend growth outperforms, much like it did in the 1950s and 60s. We know that from 1951 to 1966, stocks went up 15% a year. And it was specifically companies that had an ability to set price as inflation rose. Long-term bonds gave a 1.6% return. Inflation was 1.6%. That means bond investors got a 0% real rate of return. So what works during falling rates is not what works during rising rates. From 1981 through 2020, stocks and bonds gave roughly the same result. Over the long term, stocks have generally returned about twice as much, but during rising rates, you could see this was a 5-to-1 return ratio of stocks versus bonds, and dividend growth outperformed. So these transition periods are difficult, especially when you go through a Fed tightening cycle that makes you question whether in fact something has changed. Well, here's another clue that something's changed. The broad-based commodities index, a basket of commodities, hard and soft, declined in price from 2008 through the low in 2020 at a point where we had 0% inflation. When rates bottomed, commodity prices started to rally, and they rallied sharply from 2020 through 2021, well into 2022, 5-6 months into the bear market stocks. There's a clue, there's outperformance. They held on longer than stocks did. And eventually the Fed tightening cycle caused a moderation, yet not much of a decline. And at the first sign that the Fed might be done raising rates, commodities have turned and broken out of that trading range to the upside. So my guess is we've started the next significant leg of a new long-term commodity bull market. Now, what drives that? Well, you can imagine that after 12 or 14 years of underperformance, CEOs not that anxious to spend money expanding their capacities, and boards not much willing to approve it. For the first while, the first thing you hear is we're going to generate cash flow and pay down debt, and raise our dividends. And that's great. But at some point, if you have an infrastructure bill like we've had in the US, where trillions of dollars will be spent on infrastructure, and if you've got an EV revolution that's going to demand a lot more materials, and if you've got conflict that could be permanently changing supply lines out of countries like Russia and China and Iran and Brazil, it may be that supply demand gets out of whack. And once it's out of whack, it takes a long time to repair that balance. So we want to own companies that have the ability to set price in an inflationary environment. And commodity prices, if supply demand is tight, shows that ability. This is the broad-based commodities ETF USCI, which is the US Commodities Index. Clearly has come out of the range it traded in from the spring of 2022 through most recently. And we see this in a host of different types of commodities. Yet, during the Fed tightening cycle, investors became the most underweight in commodities they've been back to 2013. So again, positioning tends to get to the wrong place at the wrong time. Crude oil, after breaking out in 2021, moderated during the Fed tightening cycle, now twisting higher. And investors invested at about the 5th percentile of exposure versus energy going back over the last few years. So the commodities ETF versus the bond ETF, relative strength, relative outperformance through 2021, relatively even performance through 2022, breaking out to start a new leg higher in 2023. So it's all about understanding structural change. And structural change is hard because at inflection points, the tug of war between buyers and sellers can go on for months until ultimately resolves. And when it resolves, people have to play catch up. And we want to be positioned coming into this. Okay, so this leads to a discussion of the US dollar. US dollar, of course, was very, very strong all the way through the bear market in stocks, the US dollar versus the basket of world currencies, euro, yen, British pound, and others peaked at almost exactly the time when the US stock market made its low. Since then, money has come out of US dollars and been put to work. And we've made a series of lower highs steadily versus that basket of world currencies. The reason this is important is that a weaker US dollar tends to be the case when you have a bull market in commodities or a bull market in global stocks. Again, this is a shift. Now, we've had a little bounce in the US dollar over the last 5 trading days up underneath where it broke down. I would expect likely this is where it finds some resistance and turns and head lower, which again continues to be supportive of those key themes. So let's just talk a little bit about some of the more recent data. You know that our view is that 80% of return comes from the impact of being in the right asset classes. In this case, we believe equities, specifically global equities and commodities, and then finding the sectors and themes that have some kind of structural backdrop that makes their situation better than it has been in a long period of time. So a significant portion of return comes from getting to the right neighborhood. The smaller piece of return is finding securities within those groups to express the view. So we have 3 pieces in our strategy. My focus is the top-down macro view of the world, identifying the universes of securities we want to focus in. And then we use our bottom-up security selection process, but looking for fundamentally sound securities, things that are good getting better, where due to the change in their neighborhood, their multiples can expand, where people are willing to pay a higher multiple for a better outlook. If we can find areas of the market that are seeing net inflows of capital, and they line up with securities that meet our business tests that are fundamentally good getting better, this is where our portfolio should live. And then, of course, the most important part of it is having a disciplined selling strategy to recognize when something's changed, to make sure that a little mistake doesn't turn into a big mistake. We're always looking for parts of the market that are seeing expanding breadth, where over time, more and more securities are participating in a rally that's constructive. And when we see deterioration in breadth, or when fewer and fewer stocks are participating in a rally, it means the tide's going out, that people are reducing their holdings. And no matter what the index may be doing, driven by the biggest securities, under the surface, we know in that case, the ice is getting thinner under our feet. So we want to add in groups where we see expanding breadth, that's pure market signaling. And where we see deterioration in breadth, forget about what the commentary is, it means money is leaving that group. So let's talk about this a little bit. At the end of May, we talked about the fact that a significant number of our indicators had continued to improve. Percent of stocks in uptrends US was improving. That's bullish. Percent of stocks in uptrends globally was expanding. That's bullish. Canada was yet to see a shift. The short-term indicators, percent of stocks trading above their 50-day moving averages, had been rising. That's short-term trend turning positive. And the percent of stocks trading above their 150-day was expanding, more and more stocks trading above their 150-day moving average. If we look at where we were a week ago, things started to improve a little bit more. The high-low index turned higher. And as of this week, all of the short-term indicators are positive, and breadth in the US and globally continues to improve. So the balance of evidence is the market is becoming more resilient, not less. Let's talk about leadership. At the beginning of June, the average sector had 43% of stocks in uptrends. We highlighted that some important early cyclical groups, energy service, transportation, capital markets, steel, machinery, builders, all had shown significant breadth improvement in the previous month. And that on the other side, sectors that were considered to be defensive, things you might like to own if you think we're headed to a hard landing, we're seeing significant deterioration in breadth. Well, that was certainly going against the commentary. As we sit today, the average sector has 49% of stocks in uptrends, so significant improvement in breadth. And we can see that we've moved to the right here, meaning that the average sector has a higher and higher percentage of stocks in uptrends, and the best sectors in the market are the most economically sensitive: builders, machinery, restaurants, aerospace, Wall Street, insurance, steel, auto. These are early cyclicals. The things that point to a new economic cycle, not to a recession. Let's take a look at them. Now, we know that from the beginning of the year, people went back to the things that they knew from the last cycle, and certainly technology has had strong relative price performance since then. Starting in May, they started to equally return versus the S&P instead of outperforming, but they've continued to act well. Large cap tech continues to be a favored sector in retail and individual investors. And we've got a great basket of securities to address the key themes in this area. About 21% of our equity exposure, is in technology. Industrials. Now, this has been a favorite theme of ours all year long. It's one that pointed early to the fact that we're not headed to recession. We've seen a series of higher lows since October. In fact, from a breadth perspective, the low point for breadth was in June, and when the market retested those lows in October, actually more stocks remained in uptrends. We've seen general improvement since then, and we're sitting now effectively at 52-week highs. Internally, we've talked about equipment and machinery as being a favorable area. Finning equipment is one we've talked about many times. They're the distributor for Caterpillar equipment in Canada and South America. They sell into infrastructure. They sell into 25% of their sales into infrastructure in the power grid. They sell into the resource industry. They sell into the construction industry. Transports made a nice turn, trading close to 52-week highs. And home builders and home building equipment is making 52-week highs. In fact, Pulte Homes, one of our biggest holding. We've talked about Pulte, we've talked about Lennar, we've talked about Century Communities. Had a big beat from an earnings perspective today, up 9%. Sherwin-Williams, we talked about last week as being a new holding. Beat the estimate. Estimates were up, the earnings were up 37%. So estimates for 2023 We're at $8.85, 2024, $10.06. That's a 14% increase. I would say they're likely to see increases in the expectations for earnings going forward. Moving on to materials. Now, materials is one we talked a lot about. You can note that at the beginning of the bear market, in fact, by April, materials were trading above the level they were at in December at the beginning of the bear market. That is a sign of resilience. They moved in an ever-tightening band through the course of the bear market, making a low in October, and recently having broken out of that band. There's lots of different ways to look at materials. We're looking at materials producers here, not specifically the materials themselves. It's important to look at how the producers behaves. It tends to be that in a bull market, the companies that produce commodities and materials significantly outperform the commodities themselves because they have lots of leverage in their business models. Isn't it interesting to see steel companies trading at the highest levels in over a decade? When the bears talk about a significant recession coming. Well, it's probably significant, what $1 trillion in infrastructure spending might do and what a change in supply lines might do. If we were to look at Nucor is trading at new highs. But as a group today, the SLX ETF for steel made a new high for the decade. Infrastructure development companies show what's expected. We can see that after trading sideways all the way through 2022, we made a new high at the beginning of 2023, well before the S&P comes close to making a new high. And it's continued to be the case. We're trading at relative strength, new highs versus the market for infrastructure development companies. Stantec would be a great example. We talked about this one. This is a company we continue to add to. This is an ETF made up of smart grid infrastructure development companies and equipment. We know lots of money is going to need to be spent on the grid, and we want to own the companies that sell the equipment into that. This is a company we haven't spoken about before, BWX Technologies. It's a company that comes out of the defense sector. They have effectively supplied all of the small micro nuclear generators that are used in submarines for the US Army, US Navy. And now they're taking this technology to commercialize it for industry, to power things like university campuses and large industrial complexes. We do have a problem with power, and this is a company that could have some real upside, interesting opportunity as we go forward in the new age of nuclear with small modular reactors. Uranium also signaling something going on in that group, again, breaking out of that range it was in as a materials group. The bear market that went all the way back to 2014 looks like it's over. And companies like Cameco is the granddaddy of them all, making a new all-time high, trading better than 90% of companies in the S&P over the last 12 months. Copper producers, again, a highly economically sensitive group, after consolidating through the Fed tightening cycle, has started to poke its head out of that range. And we know generally the leader in a group breaks out first, and Freeport clearly has done that. So we have a lot of exposure through these very economically sensitive groups. The reason we own them is not because we think we're going into recession. We want to be positioned for the next economic cycle. Our job is to own things that have an ability to set price in a reflationary world. We're not in a disinflationary world. We're in a reflationary world. And these companies all fit that bill, many of them paying dividends and many of them with significant dividend growth and significant cash flow growth. Energy, another area that can potentially give us a significant increase in our income stream. Natural gas producers, after going sideways for a year through the Fed tightening cycle, have broken out of the range to the upside. Oil and gas services companies have done the same. We talked about agriculture last week. And we know that the energy service group will get very busy if prices move higher for energy. This is Shawcor, one of the great Canadian companies that supplies into energy services, creating equipment for the pipe and pipe services complex. If there's one company I would be watching in Canada for resolution to come out of this bear market, which so many companies are now doing, it's Canadian Natural Resources with 50 years of reserve life and arguably one of the great world-class assets in energy. So again, trying to be positioned for the next economic cycle. Now, when things go sideways for a year, it can test your patience. But we know that the market doesn't operate on human time. And if you wait till it's obvious, you're probably too late. Now, it is becoming obvious now that these things are all getting into gear. And we're happy with the positioning that we're starting with. Things that make us more positive: consumer discretionary versus consumer staples, significantly outperforming. That's offense versus defense. The financials group. This is the XLF ETF, a broad-based ETF of financial services companies, peaked out in 2007, not to exceed that high until 2001. So financials tend to do well when rates are rising. We had an initial rise, and then we had a Fed tightening cycle. And here we are now starting to break out of that range. You see it more clearly in the capital markets companies that supply investment banking, and companies that supply asset management. Had the first sign of strength in 2020 and 21, consolidated during the bear market. There was a spring scare in financial services, and now breaking out of that range, companies like Morgan Stanley. Well, JP Morgan is our largest holding in financials. It ended its bear market in 2013, way ahead of the group. That's the leader. It's the highest quality company with the best management, the best balance sheet. But this gave us a clear sign that this was likely coming 2 months ago. So just to review, our job is to hold the things that we think are going through a structurally positive change that can lead to a long-term revaluation. We know that there can be periods where they're going to chop their way sideways and we're going to get frustrated. But when they get in gear, the numbers can be significant. Our big weights: information technology, a little over 20% of the total assets that Barometer manages. We have a significant overweight in financials versus the S&P, 18% versus 12% for the index. Industrials, a significant overweight versus the index. Energy, a significant overweight versus the index. Materials, a double weight versus the index. We are underweight the most defensive parts of the market, which arguably we believe are most overowned and are unlikely to lead as the economy starts to get better. Healthcare, underweight. Communication services, underweight. Staples, underweight. Real estate, underweight. And utilities, underweight. These are the sectors that do well during falling interest rates. So we look very different than the index. Geographically, we look quite different than we did 18 months ago. And I think it's going to be important to continue to prove this out. But as it stands right now, breadth and price action supports this positioning. Since the middle of March, we've had sizable improvements across all of our portfolios as all of these themes have started to lift. But we think these themes likely lead for several years. Things that would cause us concern: if volatility picked up like it did in 2009, or like it did in 2011, or like it did in 2015, or like it did in 2018, or like it did in the COVID sell-off in the spring of 2020. All of those things would tell us there's something going on. We have volatility at multi-month lows. We know that volatility in stocks is at lows, but volatility in bonds is higher, yet people are focusing on bonds and avoiding stocks. We think the market is telling us something different. Credit risk is improving as spreads are declining. And the move into T-bills appears to be done. We think we continue to be in a structural bull market in stocks, as seen here in simple visual in the S&P. And what comes after corrections in a bear market are long run-ups in price. Now, the bull market in the 80s and 90s went on 217 months. The market went up 1,317%. That's a secular bull market. Between 2000 and 2013, the S&P went nowhere. It covered a lot of ground and there were places to make money, but you had to be nimble. This is when we built our income strategy, which so successfully helped us to guide through that period. This has been a really tough 18-month period. 19 months, the market's down 4.9%, 4.6%. Now, since the beginning of the structural bull market, the S&P's up 200%, which is significant, but nothing compared to what happened in the 80s and 90s, nothing like what happened in the 50s and 60s. We think this bull market has a long way to go. And we think we've survived the most significant test of this bull market since it began in 2013. Probably not dissimilar to what happened in 1990-91, midway through the structural bear market of the 80s and 90s. So if our indicators start to change for the worse, we're happy to get defensive. But I can say that as it stands right now, we're pretty fully invested. We have a small bond weight in our balance account, which we have to have, and in general, it's corporate debt, and they're shorter term by nature. Our strategy is more focused on dividend growth and more economically sensitive companies that have an ability to set price in a rising price environment. So we'll continue to do these calls weekly. I hope that they're useful. If there's any questions, certainly we can answer them. And we encourage you to follow us on Twitter @BarometerCA. We put up a lot of content over the course of the week if you're interested, or you can also follow the insights page on our website. With that, Pam, are there any questions?
Yes, of course. Thanks so much, David. Sebastian wants to know, Dave, what are your thoughts on cycles and DMARC indicators? What are your favorite indicators?
So DMARC indicators tend to be shorter term indicators of the strength of a short-term rally. And I think that they are effective at times. They're more effective when the market is churning its way sideways than in long-term bull runs. We tend to look at things from a longer term perspective. The cycle work that we're looking at, we're ideally looking for structural themes that could be revalued over a period of years, which is why sometimes I look at some very long-term charts. We look at the shorter term picture. Certainly, we look at our short-term indicators for signs of change. When breadth starts to deteriorate, say the percent of stocks trading above their 50-day moving average or 150-day, they give us cause to be a little bit more tactical. But the goal is to get into these structural themes and stay in them. When I look at, for instance, the structural theme in energy from 2007 through 2014, we built a sizable weight in oil and gas producers as fracking changed the way we found and lifted oil. But it was clearly over in 2014 when breadth really started to crack. And we went, in fact, to a 0% weight in energy, and in our macro portfolio went short and had a really good go. The hardest time for us is in a period of digestion, like maybe we've been in over the last 12 or 14 months as the market corrected. We did a good job of getting out of tech, for instance, the early part of 2022. And our portfolios weren't down near what the average balanced account was down over the course of the year. But I would say that from my perspective, the cycle shifts that are happening right now and resolutions in some of these congestion areas or in the charts points to some pretty good returns over the next 2 to 3 years. And we're going to more focus on the long-term pictures.
Dave, the next question comes from Bill. He says, the yield curve has been inverted for a while, and this is usually a sign of recession. Is this time different? And if so, why do you think?
It's always hard to say usually, right? Because things don't repeat themselves all the time. The reason I put that chart up at the beginning is there have been lots of bear markets that happen without having a recession actually hit. And now, if you looked at mild recessions, the numbers wouldn't be much different. You can get a mild recession and the S&P might go down 20 or 25%. but it's discounting a mild recession. It may well be that we've already had a slowdown and are getting ready to reaccelerate. We can see that in some of the PMI data. So, you need a lot of points of data to understand where you are in a market cycle. And to think that one indicator is going to be right all the time is unlikely. That's why we use breadth, because you're effectively looking at the output of 1,000 moving parts, which is the engine of the market. And ultimately, investors digest that information and then they act with their feet. And if breadth is expanding, they're acting with their feet to put money to work. And so we watch all of those things. But I can point to other occasions where the yield curve inverted and you didn't have a big bad recession.
Dave, next question here. Do you believe a hawkish Fed announcement and forward outlook tomorrow could cause a material sell-off in the broader market?
Look, the Fed has been doing its best to be hawkish over the last several meetings. In the last meeting, he worked hard at making us believe that if the data didn't support, the end of hiking, they would continue on. I will be surprised if tomorrow isn't the last hike in a while. But he likely will try to use the bully pulpit to make sure we understand that he's willing to raise rates again in the future if inflation numbers don't come under control. I think that what I would take away is there's parts of the economy that have had inflation because of supply chain problems and a bump in demand coming out of COVID. And there's some areas and that those things can get reset. And there are some areas where you're probably not going to be able to fix it. I think materials is an important one, and maybe energy as well. The market probably is positioned for the expectation that this is the last hike. But the market has shown a lot of resilience over the course of the last couple of Fed meetings when there was hawkish discussion, and the market absorbed it. When breadth models are positive and improving, it tends to be the market has a pretty good shock absorber or ability to absorb bad news. And probably that has to do with the fact that positioning is very late in the market. There's a lot of people underinvested, and I think we are likely to see a sort of buy the dips mentality come into the market, given how many people are behind their benchmark for the year, and how many people are underweight equities. We're halfway through the year, and a year can go by, and it's going to be tough to explain if people haven't participated. I think that's why Michael Wilson capitulated yesterday.
Dave, final question here comes from Tara. She wants to understand a little bit more about industrials and where you see, or if you see them, if there's more room for them to run. So industrials, and where you think that sector lies.
So look, the industrial sector underperformed for a long time. Companies were very hesitant to invest. If you look at it, really, there was a period between 2018-19 where they basically traded sideways and broke out and had a great run higher. We've basically now consolidated that move from November of 2021 through July of 2023, so 18 months of consolidation. That probably supports the next move higher. So I think that we're just at the beginning. When you make a new 52-week high after a period of 18 months and not making gains, you're starting the next leg of a bull market. Just the same way as when the S&P eventually breaches the high from 2021, that won't be the end, it'll be the beginning. When the Japanese market breaks out above the high from 1991, that's not the end, it's the beginning of a new bull market. So don't be afraid of the fact that there are some groups that have been stronger than the rest off the lows. That probably is telling you, they have some legs to them. My guess is that the theme of reshoring of manufacturing and building out of infrastructure is going to put a lot of demands on machinery companies. And if we get a new bull market in commodities, there's going to be a lot of demand for equipment. Remember, commodities markets were in a bear market for 14 years. And if you talk to Caterpillar or Finning, they'll tell you their order book is as full as it has been in years. And that's in a period where people are looking for a recession. So these are the types of companies we need to find.
Thanks so much, David. That concludes the questions we've received. As always, thank you so much for a very thoughtful and meaningful discussion. And I'll leave you with the final word.
Yeah, you know, we all have to pick our spots. The truth is, for a diversified portfolio, you need 20 to 30 positions. Our equity strategy, fully invested, is 20 to 30 names. So you can afford to be really choosy. And you can buy the best house in a bad neighborhood and not make any money. You can buy the worst house in a good neighborhood and make money. So we think that thematically, it's important to understand the things that have had some shift take place and set up a structural tailwind that could last a long period of time. And we talked about a bunch of them today. They are not the sectors that are overowned, and they are not the sectors that are expensive. They are sectors that are performing really well against the consensus view that we're headed into some kind of big bad recession. So that can always change, and we watch every day, right? We watch our top-down modeling and we do our bottom-up work to make sure that the companies can execute on the strategies they tell us they're trying to execute, and we measure them as to whether they're being successful or not. You got to do the same thing in your portfolios. So I think we're in a really interesting time. I think that the next few years could be quite different than the last few. The way that stocks outperform over time is they have rough periods and then they have really great periods. So don't be afraid of the fact that the market's getting better. It's not going to be a straight line, but my guess is we work our way higher over the next 2 to 3 years. It could be 4 years before the next major correction. And there's going to be a lot of people chasing. So thanks very much, Pam. Thanks everybody for joining in. Hopefully it's useful. If you got questions you'd like us to answer, shoot them into us via email, give us a call, shoot us a text, or go to Twitter at BarometerCA and send us a message. But we're happy to talk to you. If you're a client and have more questions, give us a call. I'm happy to jump on the line. If you're not a client, give us a call. I'm happy to jump on the line. Our business is to help families grow their investments, and we're always looking at adding new clients. So thanks very much, everyone, for tuning in. We'll see you again next week.